Stocks got a little hiccup today, starting to show some bearish candlestick patterns, some little slightly bearish patterns in the market forecast. So I'm going to break down what those patterns are, what our expectations are now, how big or deep can the near-term pullback be, what can we expect there, and then what's still working. Even with a little bit of a drop today, what's still working, what did well, and where can I find some opportunities? So we're going to talk about how we're in the midst of earnings season. The market's in the midst of a potential near-term pullback. We don't necessarily want to make new bullish trades while we're pulling back. So with today's example, we're going to look at something that has an earnings coming up. So let's go ahead and get started. Today is Wednesday, January the 24th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching today. Welcome to those that are watching for the first time. Keep coming back. Subscribe. Hit that red subscribe button down below this video. You can do that right now while you're watching. That will subscribe you to this channel, so you're always getting the videos as they're getting put up there. Also, while you're down there, click that thumbs up icon. That lets me know two things. First of all, it lets me know you liked it. Second of all, it lets me know that you want me to do it again. Do another one tomorrow. One click, easy way to give me feedback. Scroll down further, comment down below on anything that stands out to you from today's video. In the video description, I've highlighted the link here to join my daily email list that I send out, where I send out a daily email with the Market Outlook link with a time-stamped hyperlink summary of everything we talked about. So you can look over that, as well as a list of all the clusters, overbought and oversold clusters in the S&P 500. So to get that email, click that link and subscribe to that list. Follow me on Twitter for more content that I put out there in addition to these videos, usually very relevant and tied into. For example, last night we talked about the bearish dollar. Today there was an there was a comment out there from this Secretary of the Treasury. So I shared that article with you to kind of goes with what we were talking about in this video last night. So follow me there at DavidSettle42. Remember to like and retweet tonight's Market Outlook tweet. I always pin it up to the top. That will make sure Twitter keeps pushing you all my stuff. Also, join the Market Outlook community with everybody else that's watching here. Join that on Facebook. Let me know. We can be able to chat and interact with everybody else that watch these videos day in and day out. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. At the lows of the day, we had an extreme low on the momentum line. First one since the last day of the year. And, of course, that last day of the year probably was too bearish considering what's happened since then. So really the first one that we've had since early December, when we were getting some near-term volatility that we've been expecting at the end of this intermediate run. We haven't had a new near-term high or low this whole year. The low was December 31st, and today has been the high so far. We've been gradually moving that up. So we haven't really established a high yet. That's why it's blue. When it gets established, when the near-term line falls below 50, then I'll turn it red. I got a question about what these ovals mean, and again, they're ovals are just me drawing them on the chart when the near-term line peaks above 50 and when it bottoms out below 50. So that's how these all line up together. And you can see we did break up to a new, early this morning, broke up to a new 4-week high point here. So I have to keep moving these. This is the market sentiment. And these are all Fibonacci lines for the near-term run, which is in blue, the intermediate run, which is in green, and the market sentiment run, this indicator down below. Eventually they kind of line themselves up. So right now, the 23% Fibonacci retracement lines up almost with a 38%, which would be 100% of this current near-term rally. So if we were to pull back, it would be significant and doubtful. But if we were to pull back on the next near-term run down to 2,700, we'd also hit an intermediate support and long-term support, all in that same area, which is just a little bit, probably between 2,675 and 2,700. It's crazy to think, but that's where we were at the beginning of the year, and that would be a significant pullback, but it would be a pullback of just what we've gained, and we've gained so much so fast that we just haven't had a bearish candle like this in a while. A little bit of a spinning top, a long upper shadow, long lower shadow with a small body can be a reversal pattern at the end of an extended move like this. This one, not quite, and you did have a long upper shadow, long lower shadow, but the body was relatively big. This is more like it. We almost had a little bit of one yesterday, but we didn't have very much of a range outside of the open and the close. So So a big move, and you'll see that on the intraday chart in just a second. Starting to bring the near-term sentiment down. The near-term line's been above 50 this whole year, so it's going to come back down below 50 at some point. When the momentum line hits an extreme like this, then you expect that that eventually we'll get a posture change, and we did. We had a bearish posture change. It was weak, but it was a posture change nonetheless. And so, but we didn't get that. So we didn't even get below 50 to be able to call it a bullish intermediate confirmation signal either. It did pull back. The near-term line is pulling. We expect there to be a near-term pullback. Where it will get to, there's the 38% Fibonacci retracement. And lately, it seems because of how bullish we are, it looks like we typically have only been pulling back to the 23% Fibonacci retracement level. So those are going to be some areas of support there. Of course, the 23% Fib level of the current intermediate run is kind of in the middle of this near-term rally. So you're going to be right about 50%, and that would be almost a 100-point drop considering we hit 27 or 28.50 at the high of the day today. That would be 27.50 to get down to that first layer of intermediate support. And of course, the more significant layer of intermediate support will be at that congestion area right there between the 50% at the bottom of that area and 38% Fibonacci level at the top of that area. So if and when we do start to pull back, you'll get some short-term weakness here or support here, and then you'll get more intermediate support down here if we were to say get a bearish near-term high. Bearish near-term high would be getting the blue line below 50, get back up above 50, but not get into the reversal zone, form a lower high in the index, and then you'll probably now start to test, break down a little bit more to this area here, or potentially even to that area there, which again will seem dramatic, but it won't be dramatic, right? Because you can't be all happy and doing happy dance when we go up a lot more than we should, and then not understand the context when we go down a little bit more than we should, because that's just how it happens. You get near-term volatility. We get lots of ups and downs. This up just happened to be a very extended one with very few pullbacks. The pullbacks were so weak we couldn't even get the blue line to get down below 50, and we barely got the momentum line to get below into the lower reversal zone once, and it didn't even fall to an extreme, and it provided an unexpected, really good bullish intermediate confirmation bounce there that we talked about on that day, on the 16th. It wasn't a good idea to take that signal because of how bullish we were and how bullish the intermediate posture has been. All right, if you take a look at the Dow Jones Industrial Average, you can see it's pulling back too. Same thing, spinning top pattern on its chart. The NASDAQ Composite, which has a lot of those large cap tech names in them, got a little bit of a bearish engulfing pattern. So the body, today's candle is bigger than yesterday's body and engulfed it. See, that was a dark cloud cover pattern there on the 16th, and this is an engulfing. So another bearish signal. Again, momentum line didn't produce a bullish intermediate confirmation signal there. And then finally the Russell 2000, which has been less bullish than the large cap index lately, so it hasn't been so extreme to the upside, also forming that same kind of engulfing pattern. Its momentum line did drop down to the reversal zone, and now has a bullish intermediate confirmation signal. For those who are new to what that means, when the trend is strongly bullish, which is measured by the green line, when it's up here above 80, and the red line, which is very short term, drops below 20, that's like a buy the dip. And we talked about on the 16th, probably not the best opportunity to buy that dip, and in actuality it was for a few days, right, for about 5 trading days. Same thing here. The odds of that working out are getting lower. Not 0%, because nothing's ever 0%, nothing's ever 100%. I saw something today, an ad for a service, an investing, a newsletter service that for somebody, if you go to their classes, this somebody will teach you how to always put the odds in your favor. Anytime you hear the word always or never in any kind of sales pitch, or any kind of guaranteed return in any kind of sales pitch, then you know that service probably isn't the most legit service at all, because you can't guarantee anything, and there's never zero. The odds of something happening are never 0%. They're never 100%, because this is a market of humans, and human psychology plays a huge role. So literally anything can happen. We have to base off our expectations. So the expectations are, yeah, we have a bullish small-term signal here, like we did a week ago, but just like a week ago, the odds aren't very high for that to work out. So we wouldn't take that, and we expect more of a near-term decline than what we've got in just one day today. All right, the long-term chart shows an interesting pattern. So you see we have a long upper shadow here, and you get long upper shadows when you run out of gas. And when we get far away from the moving average, because when you're pulling away from the moving average, you're usually closing at the highs. Remember, this is a weekly chart, so all these candles were closing on Friday at the high of the week. When we're far up above, you know, see how when you push off of it, that's what happens. You close at the high of the week. When you get to the point where you're so far up above, but you're not closing at the high of the week, and you get, you know, last week we had a long lower shadow, bearish, but not as bearish as a long upper shadow would be. So tomorrow and Friday's close will be very, very important. If we pull back the next day or two, you know, even, you know, if we close, you know, even if it's just by, you know, through ups and downs, you know, close another 10 points lower, but and make that candle even more of a longer upper shadow, then you know, okay, now we're going to get more of this. You know, here we were so far up above, we got that long upper shadow, and then we had 1, 2, 3, 4, 5 weeks where we were down 4 out of the 5, or no, sorry, 1, 2, 3, 4, 5, 6 weeks. We were down 4 out of the 6 weeks as we pulled back to the 50 and bounced off of it. And same thing to a smaller degree there, where we were down 2 weeks, but smaller bounce off the moving average. So again, very important how we close this week. If we close at the high, okay, we still, you know, we haven't got the long upper shadow. If we pull back down today and tomorrow, which, you know, again, kind of is expected because that near-term line's starting to pull back, and it's been above 50 for so long that the odds of it dropping below 50 are getting higher. Not to 100%, but they're getting higher. So we kind of expect that to happen. If we know that does happen, then expect more weakness as we pull back to that now just about parabolic 50-day moving average there. Looking at the 3 green arrow chart, you can see obviously still got 3 green arrows. Same thing would hold true for the 8 and 17 day. When we get so far up above that and you start getting, you know, some bearish candles when you're so far away, then you know, okay, now we have the odds. Now, a week ago we could say the same thing and we just bounced off of that. So again, nothing is guaranteed, nothing is 100%. We could bounce right off of this too, but the likelihood of that happening are lower now than they were then, and they were low then. You know, what are the odds of 2 low probability occurrences happening? Obviously very low when you multiply them together. The MACD is up above its moving average, and the moving average is in a straight line essentially. Stochastics is also extremely, its moving average is extremely high and close to crossing down below it. Again, we break down, don't think this is it, right? It's just a small pullback. We never go from strong bullish to strong bearish. There's going to be some bounces until, you know, we're going to trade in this area for a while before things really get going. All right, now when you look at today's intraday chart, you can see a higher high, lower low. So there's your outside day. Not as engulfing as it could have been, as it was, like say on the Nasdaq, but because we did finish within yesterday's range. You can see we have to move the 4-week high up now because we did get a new high here. Actually, that line's got to go up too a little bit. So there's the high, and again, remember, we're not moving the 4-week low point up, so that 4-week high just keeps on extending itself. I'll move this up too. The other one was the Fibonacci line. So there's where your Fibonacci support's going to be on any kind of pullback, right in that area, that 275 3/4 up to 277 3/4. So that area is going to provide the support on any kind of initial near-term pullback, which again would obviously still be in the upper half of this very large 4-week range, and we typically don't break down to the bottom of a large 4-week range. Usually you do break up to the top of a very large range when you're at the downside because the VIX is higher. We usually don't drop down that far that fast without moving this up first and tightening up the channel, then breaking down. As you can see, just getting up to that level will tighten up the channel to a 8-point range, which would then be, if we're trading in the lower half of that range by the time we do that, then there's a good chance we can break down to the downside. But you know, as bullish as we've been, you can see the volume has been picking up over the last week or so. Very, very strong volume, and we had more than 1.5 times the average volume again today. The trading range today was almost 3 points, 2.86. Put that in the context. 2.86 is off the charts. That continues to rise. The volume was more than 1.5 times, so that continues to rise. That's not bullish when these lines are rising. it's bearish. Now the nice thing is they're rising with us going up, so it's not like, you know, there's not like you know, when these start coming down, then we'll just start to grind higher. So I wouldn't be surprised if we get some volatility, but nothing, you know, changes the long-term trend. But then we start to grind out and bring these lines down to lower points before we get more of a sharper downturn. Finally, let's look at the VIX here. You see it bounced up, did not get above 12, so it's not the end of the world here. But we did form a higher low point, so we can duplicate that and move it. Let's see if it will let me. It won't. Here, let me try it one more time. There we go. So we'll move this over to here. Get rid of that one. All right, so there's the new high point, and so far it's lower. But we are coming up off a higher low, so we actually expect that volatility to get higher. I don't think it will get any higher than this 12.5 to 13.5, 14 area as we do continue to bounce. But then, you know, then we'll get that near-term volatility, ups and downs in volatility, ups and downs in the index itself that we haven't gotten yet, right? We don't go from strong bullish, strong bearish moves. We go to strong bullish, then we get some volatility, then we go down some bearish. So all these charts are supporting that idea too. You can see. Not only has volatility been rising on an absolute basis, remember, it's also been rising on a we haven't come down to these lows, 75% lows on the relative basis. We're forming a new higher low point here as well, so we're starting to trend higher in volatility. You know, which again just means the trend's still bullish, so we can't be bearish. But it does mean that we can really, really protect positions, reduce positions, put on some protection, any new positions, manage that risk, small positions, higher probability. Don't look for big returns when the market's not telling you to look for big returns. All right, let's take a look at what's driving the price action today. And really quickly, a reminder to like and retweet. Let's get back over 100 here on the likes. You know, if I can get this out quicker at night. But let's remember to do that. Again, the purpose of doing that for you is that Twitter will keep, you know, the more you engage with somebody, Twitter will keep showing you their tweets. But I also want something else. I want you to do something else here. I'm going to show you how to do this. Again, it doesn't matter if you have followers or not, because I'll retweet what you put out there. But one of the popular hashtags on Wednesdays is this Wednesday Wisdom. And so I would love to hear something you've learned from listening to these Market Outlook videos, whether it's me or Brandon that's done it over the last week or so. What's something that stood out to you that you've learned, that you've picked up? And what I want you to do is go to this button right here. It's the retweet button. It will you can click on retweet right away, but here you can add a comment and quote tweet it. And I want you to type in the Wednesday Wisdom, and then type in anything that you picked up, that you've learned from these videos. I'd love to see what nuggets that you guys are getting. What are the light bulb moments, so I can share those with others as well. All right, so now let's take a look at how these different asset classes perform. Of course, crude oil is the big one. You know, it's been more volatile. You know, it had some bullish inventory data out. It was bearish last night, but the EIA was bullish, and you can see it rallied. It was down for the day. The dollar stayed down. The dollar is just getting hammered. So gold did well. Dollar came out. There was a article out about, or a comment from the Treasury Secretary about the benefits of having, it was this one right here, the benefits of having a weak dollar for us. And so that put pressure on the dollar, and the dollar's just been in free fall. And we coincidentally, we talked about that last night, about, the dollar falling and how you look at that, breaking through 90 now, which is a significant area for this. So breaking through 90, dropping to the downside, pushing those Bollinger Bands apart as we continue to move lower. And so, what's the consequences? Well, this is the consequences right here. Emerging markets, gold, and energy, they're all denominated in dollars. They do the best, by far the best. International stocks outpace U.S. stocks typically, and those are developed. And look at large caps too outpacing small caps, because they benefit more from that weak dollar than small caps do. So right there is a picture-perfect chart of what happens when the dollar is weak. But coincidentally, bonds, the bonds have been kind of going with the dollar. So dollar goes down, bonds go down too, which means yields are going up. So that's another big mover today that's kind of influencing the markets is this jump higher in yields to 2.65% After last week, you can see last 2 weeks have been really bullish. That 50-day moving average really starting to take off now. But today jumping back up after yesterday's pullback, jumping back up. So yields continue to push higher. Rate hike expectations continue to be above 70%. So they're still high, and you can look at the rates for successive meetings in June. A little bit of a pullback on that second one, and a jump up in just one, but still the second one's still a lot higher odds. And of course, we look at September for that third one, that third rate hike, which is this dark blue line. It pulled back a little bit, and the odds of only getting one rallied up. So so the market's kind of getting a little, the futures market starting to wondering maybe things are getting a little too hot. And of course, that's just pullbacks. I mean, when things get too hot, then they're going to raise rates more. But on the other hand, those futures also kind of match this economic surprise index, and it's been pulling back. When it rallied, so did all those rate hike expectations. As this pulls back, yeah, you're going to get a little bit of a pullback, but again, temporary, because the more the economy, the market stays as bullish it is, and the economy is as bullish it is, with the 3% estimates for GDP plus 3% plus estimates, then the Fed's going to raise rates as much as it can to keep things from overheating. But again, that impacts, as long as the dollar stays weak, those rate hike expectations will keep bond prices down there with it. And again, stocks don't have to go down, but they'll have a headwind. They'll keep it from going up as much as they can, especially when other central banks, especially in these developed nations, are a lot more. They're still in their QE mode. We are out of the QE mode, actually tapering it a little bit and raising rates. They're still in QE mode and they haven't really raised rates too much. So that's going to make them look more attractive. Those stocks in those areas look more attractive, which again reiterates the point. We need to have international exposure in our portfolios. You could get away without having it the last so many years, but last year you would have underperformed. As bullish as the market was for the S&P 500, you would have underperformed if you didn't have international exposure because of how bullish they were in 2017 and the same things expected in 2018. If we take a look here at the sector performance today, early on when the markets were bullish, early on it was materials, gold, right? The stock we looked at yesterday was in that gold sector. You also have consumer discretionary. Netflix continues to be strong. Another stock we've looked at lately, you can see healthcare, financials benefiting from this rise in yields. But then from the high of the day here to the low of the day in equities, what brought us down the most was technology and discretionary. So those big momentum high flyers pulling us down. Energy giving back some gains too. And look at utilities. So utilities, they were down by the end of the day, and they're still considerably down over the last 4-week period. So looking at the 4-week range, as bullish as we've been in the S&P 500, up over 6% gains for the 4-week period, 4.5% loss in utilities. There's going to be opportunity. Real estate starting to show that opportunity. There's going to be some opportunity to get in, some decent yields too, in that utility sector as we start to bounce off those lows. All right, one stock that I want to take a look at for our trade idea of the day is Apple. We've looked at Apple a lot for different trade ideas. This one has earnings coming up on February the 1st. It has earnings coming up here in about a little more than a week. And it showed some weakness today with good volume and 3 red arrows. So there's some pretty decent weakness here. But the last time we had earnings on this quarter, it was bullish a year ago on this quarter. And you can see other earnings results, not as big of a move there. Bullish response there, a bullish response there, but mainly flat after that one. So you can see the last few earnings have been positive to no reaction at all. But again, heading into a year ago, this earnings that we had a year ago, we were kind of flattish, and we were already pretty bullish over the 2 months heading into that. We haven't been as bullish this go around, and we're actually showing some bearish signs here. So if that ends up being a bad quarter for the company, is there a way we can keep it cheap in case it does blow up to the top, but take advantage if this bearish signal that we're getting today with the volume associated with it if it plays out to be something more. And of course, the bearish sign would be saying, okay, well, let's buy a put. Here we'll go out 50 days in March and buy this put for $300. It's pretty cheap. I mean, $295 a share versus $174 if you were to short that. So much cheaper. Keep my risk minimal. But because the volatility is so high here, see how high the volatility is at 37? And just to give you an idea, if I were to take a look at selling that put at 165 to help reduce some of the cost, I mean, look at when I go to the Theo price here, and if I were to drop this 37% down to the 25 that it is in March, 26-ish, so let's say it's dropped the volatility down, we'll reset that and drop it down by 11 points. No, 9 points. By 9 points. Then you can see the price. The option we want to sell for 96 cents should only be 40 cents. If the volatility was in line with those longer dated expiration cycles. So I mean that's 46 cents per share we can make, boom, just from volatility dropping after the earnings comes out. So that's a nice benefit here to that. And you can see that this option will expire really close, well, a day later after that earnings. So in fact, you'll lose all 96 cents. The question is going to be how much intrinsic value it will have, but you know you'll make all 96 cents or most of that once the volatility comes out and the time decay, right? If I were to, now go to February the 6th, because it's February 1st after the market, so February the 2nd, you can see now all of that 96 cents is going to be gone. So we'll make that 96 cents. Now the question is, if we go up to the upside, how much does this have to go? So now let's take off the volatility change, because we're not going to get much of a volatility change. Maybe, let's say, a couple of points if we do go up. Let's go 3 points. Try to be a little conservative. So that price will go from 295. We'll lose $1. So that's about what we're making. And of course, if there's any price goes down, the stock price goes, up, then we'll keep losing money, right? You see that now that Theo price is changing. But if it doesn't go up and it comes down to that 165 area, so which would be what? Here, let's reset. Bring the volatility down, and then the price is at 174, so we'll bring it down $9 down to that 165 area. Now I make that dollar on the 165 I sold, because it's not in the money. And once it was 165 and change, right? So that 165 puts out of the money still by 22 cents. So I'll make that whole dollar there, and then I'll make another $4 from this option, almost $3.50 per share from that option going up. So it's a play to make a move to the downside if the stock does go to the downside. If the stock does go to the upside, and probably not as much to the upside, but let's say it does go up $9 to the upside, then I'll make the dollar on the other one. It still expires worthless, and then I'll lose about $3 here. So I'll lose about $2 for the opportunity to make about $4.50, $5. So pretty decent opportunity, and because of that volatility so high, and I'm making that 90 cents just from time passing the volatility changes, it makes it a higher probability calendar spread than normal if we do in fact go down with a good potential reward because of that short put. Now if it goes down further than that, I'll give some of that reward back, because now that short 165 put will end up in the money. So if you go further past 165, then I won't, because now we'll have intrinsic value that I have to give back. But 165 is $9 away, and if you look at the at the monies right now, you're looking at about an $8 range is what the market's pricing for a move. So $9 is just a little bit out of that range. It gives us some room to work with. And if it goes $9 to the upside, great, small loss. We'll just keep that loss small, and we'll position size small, knowing that we can get a 2 to 3, 4 to 1 reward to risk ratio by the time if it does go to the downside. So a great, easy, forgiving way where we can manage risk and keep losses small to trade an earnings announcement, one as big and volatile potentially as Apple's could be. So with that said, to summarize, markets are still bullish, but they're really they're more volatile than they should be when we're as bullish as we are. So that suggests, at some point in time that near-term pullback is coming, and it's going to be more volatile than a typical near-term pullback, because the near-term run has been more volatile than anything we expected, and especially more than a typical near-term rally. So we're seeing more signs of that near-term pullback coming sooner with the candlestick patterns I pointed out today, and with the market forecast patterns on that chart. We look for some areas where we can pull back to. Don't expect a big pullback, but one, it'll be bigger than what you think, because the move higher has been so big, those Fibonacci lines are deeper than normal. So that's going to be coming. It will not be significant. So don't think that now we're in bear market mode. It will not be significant, most likely because of how bullish we are now. We get the bigger pullbacks when we've pulled back some, and when we're grinding more sideways. That's when you tend to get the deeper drops. As always, subscribe, like, and comment on today's video down below. Remember to also follow me on Twitter for more content that I go throughout the day, throughout the week, that I usually try to tie into what we're talking about in these videos. And then finally, to discuss this with others that are watching it too, make sure you join our Facebook community, the Market Outlook Facebook community. As always, thank you very much for watching tonight. Have a great evening, everybody. We'll see you all tomorrow.